All right, so in this unit we're looking at the addition of having temporary accounts, whereas instead of having revenues, expenses, and withdrawals just affect capital every time, now they're going to affect their own individual accounts. So we're going to have a sales fees accounts. We're going to have, which would be revenue. We're going to have a rent expense. You're going to have utilities expense. You might have a miscellaneous expense. You're going to have a owner's withdrawals account. So it'll just be just like if it was Mr. Welsh's comma capital, you're going to have Mr. Welsh's comma withdrawals, and that will be an owner's equity account. So these all affect capital. So this will kind of give you an idea of how the normal rules for capital. We have a credit is an increase, a debit is a decrease to capital, and the normal balance is always the increase side. So with expenses, because expenses decrease capital, it's going to be a little confusing. Expenses increase themselves as a debit, and they decrease with a credit. This will make a lot more sense later on. Right now, we just need to learn these rules. Just like we learn the rules for assets, we learn the rules for liability, we learn the rules for owner's equity. Now we have 3 new sets of accounts we need to learn the rules for. Expenses, increase with the debit, decrease with the credit. Revenue, this is money coming in from sales of goods and services. We increase with the credit, decrease with the debit. Withdrawals will have the same rules as expenses in that they increase with the debit, decrease with the credit, and the normal balance is debit. It's really important. We just need to make sure we learn these individual rules, and we'll have a cheat sheet that you'll see later that will have all these rules laid out that you'll be allowed to use when you're doing transactions until we get these rules memorized.